Good morning, everyone. Ben Driggs here. Sorry, we're a couple minutes late starting here. We have DJ who will be helping out behind the scenes if you have any questions. So before we start, just as a reminder, we're at Navigate Financial and we host these monthly webinars to talk about events of the day. This time we're going to be talking about oil prices. That's on top of mind for a lot of people. But our next one is going to be Thursday, June 11th at 10 o'clock. So we have these every month, the second Thursday at 10 o'clock. And we have a lot of people who listen in. We invite you to listen in. We certainly invite you to ask questions. Just raise a question. DJ will be monitoring those questions as they come in. And we will go ahead and start. We'll end at 10:30 here. So we have about 25 minutes together. And thank you for spending some time with us today. So today we're going to be talking about oil prices and how that is impacting the economy and the financial markets. So before we start, I wanted to give a couple of things for people to keep in mind, not only as it relates to today's webinar, but just in general, a couple of concepts about investing that are worth noting. The first is the distinction between Wall Street, which is the stock market and the bond market and things like that. And the second thing is Main Street. And Main Street is what is happening with the economy. So these are the two different things, and they don't always correlate. Sometimes Wall Street is very exuberant, stock market's up, people making lots of money, but then the economy is struggling. And it could be opposite, right? Over time, those would be roughly correlated. I think we have a situation right now where we have Wall Street being very bullish, very confident. Stock market in the last couple of months has really gone up in spite of the fact that we have these oil prices are high, inflation is high and moving in the wrong direction. So we have these competing things, which makes things quite complicated. So just understand that those things are not the same. And you're going to be getting mixed signals in today's webinar and also from the media. As you listen to these different things, a lot of things simply don't add up. That's because they are complex. So
real quick before we pop in, I just want to make sure everybody who's listening, can you throw a thumbs up or one of the things, if you can see the screen that says Beyond the Gas Pump. We just want to make sure everybody this morning, the system's having a little bit of issues with our cameras and screen and stuff. So, okay, we're getting a ton of thumbs up here. So we're good. Okay, I just want to make sure everybody could see it. Okay. Or that most people could. So. Okay,
fantastic. So we're going to cover half a dozen items today: why oil prices matter, the impact, the ripple effect, winners and losers, growth stocks versus value stocks, which again is relevant today in today's conversation. But just as a general concept, it's worth noting that stocks are not all the same. There are some stocks that are considered to be growth stocks, some that are value stocks. We'll talk about that. The difference of what's happening domestically in the markets and what's happening internationally, and some final takeaways. So about 6% of the US GDP is tied to energy production. You can read through some of these things where oil prices show up in everyday life. It's just not at the gas pump. That's why we decided to call this Beyond the Gas Pump. Now, the gas pump is where people, they drive by, they see higher prices. But when oil goes up, there is a rippling effect that goes on throughout the economy. And in general, unless you are Exxon, that is typically negative on a lot of different fronts. And there historically has been a correlation with rising oil prices and economic recession, or at least a weakening of the economy. But if you go back the last 40, 50 years, I mean, when oil spikes are high, when oil prices shoot up, that is typically a harbinger of bad things that are around the corner. And I think it's a little confusing right now because the stock market has been going up, notwithstanding these oil prices going up. And for people like me, are kind of like, that doesn't make sense, because there should be some economic pain that is lurking around the corner, and we're not seeing that yet. So typically there's going to be a delayed effect. And so on one level, if the delayed effect happens, and if the war continues and we have continued high oil prices, I think it's going to be hard to avoid some negative economic impact. Now, why are the stock markets going up? I think the stock market is going up for different reasons. The AI boom is still in full throttle. People are really excited. You have a lot of people jumping onto that bandwagon. So that's what's happening with stock market. Shouldn't be confused with what is happening with the economy. The economy at this point is still pretty decent. Unemployment is still, not too high, or I should say, employment is still pretty solid. Inflation is inching up, but it's not, at levels to be too concerned with. So at this point, we're kind of neutral on the economy. We'll see what happens over the next few months. Rising prices everywhere. We see here the chart that has this correlation. This is over the last 25 years. You can see a pretty strong correlation with how prices rise everywhere when oil goes up. And I think this year it's no exception. So we're starting to see elevated prices. We had elevated prices 2 days ago on the month over month. On the April inflation numbers came in a little higher than desired, and slightly more than expected. Yesterday we had producer prices up notably higher than expected, and certainly higher than desired. So I think we're starting to see, maybe we're in the second quarter, or the fourth inning of these price elevations. Consumers get squeezed and businesses get squeezed. I'll let you go ahead and scroll through some of these things, but when there is inflation is really the bad wolf at our door. We saw this a few years ago in 2022. It's really difficult for everybody. Companies get hurt because their margins get squeezed. Consumers are hurt, obviously, because their dollar doesn't go very far. And as we see in bullet point number 3 on the left, the lower the income, the more that oil prices hurt. So we have an acceleration of the K-shaped economy, which we've talked about. Higher wage earners, wealthier people, so gas is up. Yeah, it's an inconvenience if you have lots of money and you have a strong income. But when you do not have a strong income and you're paying higher prices at the grocery store, at the gas pump, these really hurt. And so it is accentuating this economic divide, which is quite problematic, not only from an economic standpoint, because it creates greater economic instability within the system. There are social costs associated with a disparity of wealth, and there are political costs. I think we're going to start seeing this. If things continue this way, there are going to be political consequences in November. I don't think there's any way that the Republicans survive if this continues the way it is, because the basis of the Trump victory in 24 was, hey, economic, we're going to make your lives better economically. Most people at the end of the day vote for economic reasons, and right now people are really unhappy with the higher prices. And at this point, that is only looking to get worse. The Fed factor, the Federal Reserve Bank, it's worth noting we have a new Fed chairman. Now that this Fed chair doesn't have any more power than the prior or any of the other voters. There are several people who vote on the committee, but the Fed is signaling with this new chairman, he is not happy about inflation. And there's a feeling that the Fed was not aggressive enough in bringing down inflation several years ago. Biden got hurt with that. The Fed took a lot of slack for that. There was a lot of pain when the Fed raised interest rates to slow down the economy. It finally started to work up until up until the war, quite frankly. We're finally bringing inflation back to levels that would say, okay, now we can start lowering interest rates, kind of get back to normal. And then in the last 2.5 months since the war began, that has been turned on its head. Now we have higher inflation, not only today, but forecasted at least for the foreseeable future. And so the Fed is no longer going to be lowering interest rates, certainly in the short term. And it may, at the beginning of the year, we thought the Fed would raise interest rates slowly throughout the year. But now, not only is the Fed very unlikely to lower interest rates for the rest of the year, now people are thinking maybe the Fed even has to raise interest rates. This higher interest rates, people do not want that. Stocks don't like that. Bonds don't like that. Bonds certainly don't like that. About the only people who like higher interest rates are banks and people who have money sitting in cash. But that's not going to move the economy much. At the same time, the Fed wants to lower interest rates to keep the economy going. So what is the Fed to do? Is it to, and right now the Fed is just saying, we don't know how this plays out. We're just going to keep rates as they are. And that's probably going to continue for the next few months. But if the war continues and there's no sign of a cessation of these problems, as this deepens, inflation will continue to go up, and the Fed will, be put in a more difficult position. It may need to raise interest rates. The winners: energy, materials, utilities. You can read through these. There are some people who win when oil goes up, but the number of winners is offset by the number of losers. These are just sectors: airlines, transportation. Consumer discretionary is interesting. Consumer discretionary are the things that people don't have to. The things that people have to spend are called consumer staples. So what we're seeing this year is this, in the last couple of months, a real demarcation between consumer discretionary stocks, which have gone down this year. Consumer discretionary stocks are about down 7% so far this year, 7 or 8, and consumer staples are up about 7 or 8. So you have this big gap because money is moving toward Walmart, Target, Costco, bank stocks. What are consumer? You have to bank, you have to, you pay your utilities, things that you kind of have to do. And things like restaurants and airlines, they are the losers. Other ones here, there are a few that are kind of mixed. Technology, it's a whole different discussion. Technology is going up because of the AI boom. Historically, you would expect tech stocks to get hurt with rising interest rates and inflation. We saw that in 2022 when inflation shot up. Technology got hurt worse than other sectors. But ironically, this time around, it's going gangbusters in the last several weeks. And I think that has something to do with completely not related. So financials, healthcare is defensive. People still have to go to the doctor when they're sick. Growth versus value. As I mentioned at the beginning of the webinar, there are two different kinds of stocks. Growth stocks, which you buy a growth stock based on an expectation of future value. So these are technology. Companies aren't making a lot of money today, perhaps, but we think, hey, they are going to be making money down the road. So you're willing to pay a premium and buy a company for the the hope that down the road you get money. The opposite is a value stock, and a value stock might be a value because it's on sale. That is one definition of value. But in general, the value stocks are, as they say in the first bullet point, priced on current earnings. These are dividend-paying companies. They're more stable companies. They are producing income today. And so I don't know, Walmart is a value stock. It may be expensive. Costco's kind of expensive because Costco has been growing, but certainly like a railroad would be a value stock because it's just churning out an income very predictably. So you're kind of the brick and mortar kinds of industries that drive the economy tend to be value stocks. So what we've seen since the beginning of the war is that value stocks have come down. Well, everything's gone up in the last couple of months, notwithstanding the war, but growth stocks have gone up a lot. Value stocks have kind of struggled because value stocks are really looking at the here and now and the short term. And they're going to say, gosh, the economy there's some trouble brewing around the corner. If these prices continue to be high in the oil market, I think that companies and consumers are going to be, behind the 8 ball. I'm not really confident there's a lot of strength there. So that is, that's one reason why there's some pressure there. They have been going up. But as I mentioned here, ironically, this time around, growth is doing better than value. On the left-hand side, growth stocks. I think most people would say, hey, we're having a little growth run here. But the longer this goes on, I would put my money on value doing better than growth, because the longer inflation sets in and higher interest rates, that puts pressures on growth companies more. And as we say in the first bullet point, when you're thinking of the future earnings and you're saying, wow, there are a lot of pressures for these, companies, tech companies, I don't think they're going to be worth as much in the future as I thought yesterday. So that growth value debate, and then we'll go to domestic and international. Domestic stocks have done better than international since the war began. Mainly because the AI boom is just in full gear. We've had a few things, U.S. energy producers. An important one to understand is when oil spikes, oil is denominated in dollars. When there's an increase in the oil, the dollar strengthens. So when the dollar strengthens, that helps domestic stocks, which are dollar denominated, compared to international stocks, which are in a foreign currency relative to the United States. So in the last couple of months, international stocks have lagged domestic stocks. At the beginning of the year, for the first couple of months of the year, we had themes coming into 2026, and a major theme was international will do better than domestic. And that certainly continued for the first couple of months. I was feeling very, prophetic there and saying, hey, we're on the right track. But that has reversed. Year to date, international stocks are still outperforming domestic stocks a little, and I continue to think that international will be doing better. But certainly in the short term, the international markets are getting beat up. There's a lot of oil dependency on oil, particularly in Asia. Asia is feeling much more pain than the United States. The United States is a strong producer of oil itself, dollar denominated. So, if you go traveling, if you were to travel, in February, the dollar was weak. And so I guess the dollar's strong now, so you could go travel and you could have, your dollar would go further today than it did a couple months ago. So if you're looking to travel internationally as a U.S. person, your dollar is going to go farther now than a couple months ago. But anyway, here's some takeaways. Diversification is your friend. These things go up and down at different times for just different reasons. When you have a lot of different pieces that are fundamentally different, moving at different times for different reasons, it tends to smooth out the ride. You're probably going to get the end result anyway, so you might as well have a smoother ride. Number two, sector exposure. It's a little technical. We won't go into that, but there are considerations. Should we go with large companies or small, domestic or international? Should we go with oil companies or banks? These are things that we can talk about. Again, a little under the hood for most people. Value versus growth. I think right now there should be a rough balance between those two. I think at the end of the year, I think value is going to do better than growth this year. Year to date, value and growth are about even. Protection against inflation. We want to be sensitive to this and invest in things that do well. That's commodities, real estate, hard assets. Gold has been taking it on the chin. Gold tends to do well with deflation, not inflation. So gold has been swimming upstream recently. But those are things we can talk about in general. One other thing, dividend-paying stocks, these value, a company that will pay 3 or 4%, are attractive because those companies are still making money, and they can provide some income and stability to the portfolio, whereas the bond market, which is relatively flat year to date, the bond market does not like inflation and high interest rates. So right now, the bond market is underperforming what we expected coming into the beginning of the year. If the economy weakens, the bond market should do well because interest rates should start coming down. Worst case scenario is high inflation and the economy weakens, and the weakening of the economy is not enough to offset. That would be a very undesirable result. Avoid reactionary moves. Yeah, that's just long-term focus, and you should be fine. Stay informed, stay disciplined, and whatnot. So and here are the disclosures. So with that in mind, let me go to our Do we have any questions? What's time? 10:26. So do we have any questions?
We don't have any that came into the chat or the Q&A yet. If anybody has any, throw them in there. Anything that, came up that you want, maybe to learn a little bit more about, something like that.
While you're thinking of that, if you have any questions, let me conclude by saying this. What we're seeing right now with high oil prices is economics 101 at play, and that is the concept of supply and demand. So since the war began and the Strait of Hormuz has been closed, the production and the supply of oil going through that strait it constitutes about 20% of the world oil supply. So when supply goes down by 20% and demand remains constant, people are still driving, factories are still in operation, people are still flying, and whatever, all these different, there are a lot of other things besides gasoline. Farmers need oil-related products, etc. So demand is remaining constant. Supply goes down by 20%. That results in a price increase. Now, what has been happening is that countries are dipping into reserves, and they're being very creative and juggling around. That is bridging the gap by about 5%. So that's helpful, but we're still at a 15% deficit. Well, the longer this goes in, if you lose your job or get a 20% pay cut, you can live on savings or you borrow from friends and neighbors. And like, hey, I can get by for a while, but the longer the problem exists, the more difficult it is. The reserves kind of now start to be depleted. And there are only two things. Prices must continue to go up, or demand will go down. Because as prices go up, people say, I can't go on that vacation. Companies say, I can't afford to ship that thing. The transportation costs are so high. People go to the store and it's like, wow, it used to cost me $100 for all my groceries. Now it's $120. I can't afford $120. I can only afford $100. So I will simply buy less product. Okay. So you have what is called demand destruction. So with inflation, with it being the longer it is, the more you have demand destruction. So what happens when people are buying fewer groceries, when they're traveling less, when people are manufacturing less, when companies are manufacturing less, when this demand destruction sets in, then that becomes recessionary. And then they start laying people off. Then you start having problems. I think that helps and would help inflation. And I think that ultimately will bring down interest rates. But it would be a painful thing. And hopefully we can avoid that. Hopefully the answer is simply to have a diplomatic solution. Let's get this war behind us, get back to normal. If that happens, then I think the economy should be fine for the rest of the year, and the financial markets should be fine as well. Thank you all. No questions?
Yeah, there was one question that came in. Yeah. The question is, would you buy oil right now or not? What would be your opinion on that?
You could. I think it 100% depends on what's going to happen with the war. So I think it's a flip of the coin. Trump, if he's being politically savvy, would try to get out of the war as fast as possible. I think he's trying to, but I think that he's more fixated on eradicating the nuclear capability of Iran, even if it costs, there's an economic cost. So that he could pivot though at any time. And so I think that's kind of a gamble. I wouldn't mess around with stuff like that. That's not my style. You diversify, you let things go, you tweak here and there, but I don't like to make big moves during times like this. It doesn't usually pay out. Well, you could. 50-50, flip of the coin if you like that sort of thing. Any other questions?
No, I think that's the only one that came through. So we're
okay.
Good.
We don't have a topic for June yet. We are going to see. We usually wait for a few days before the date to make a decision. I was planning on talking about the Fed and how the Fed works and the new Fed chairman, because, Fed is kind of technical, blah, 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 just boring stuff. However, just to basically understand when you hear the word the Fed raised interest rates or the Fed this or that, just so that listeners can feel like, I actually kind of know what the Fed is. That's a topic that I had in mind, but that got preempted by what we consider to be a more timely topic, and that is oil. So we'll let you know. Thank you very much. Until next month, goodbye. We appreciate your business and your time. Take care.